Now, whether we're talking about the NEOS NASDAQ 100 ETF, one of my favorite higher income ETFs, ticker symbol QQQI, or the S&P 500 version, the NEOS S&P 500 high income ETF. Both these ETFs have been very popular, especially across the dividend income community, because they offer exposure to the NASDAQ 100 and of course the S&P, two different asset types that a lot of us dividend investors do want more exposure to, but through a high income strategy, which as of right now is offering around a 12% or 14%-ish distribution rate. Now, one of the things you've probably heard about both these ETFs is that even though they pay a large amount of income, around, like I said, 12% to 14% per year, as of right now at least, both the ETFs pay the income very tax efficiently. Now, to be even more specific, NEOS just tweeted this out as of today. It says this material must be preceded or accompanied by a prospectus. To view the prospectus for each ETF, visit the website, etc. But this is where it gets interesting. Distributions made by the funds have been classified as a return of capital and may be comprised of option premiums, dividends, capital gains, and interest payments. As the most recent distributions by the funds, and we're talking about the May distributions, the distribution composition for each of the funds was estimated to be return of capital in the following amounts. So CSHI equals 64% return of capital, BNDI 70%, IWMI 100%, SPYI, my personal favorite NEOS ETF, 96%, QQQI 99%, HYBI 74%, QQQH 98%, BTCI, one of my newer favorites, 97% return of capital, TLTI 67, IYRI 94, and SPYH 96%. It also says please see the 19A-1 notices for more comprehensive breakdowns. Now, whenever investors ask me about ETFs and how they're taxed, I always tell them to go to the actual ETF's website. Normally, they're going to have some information about taxes. If you go on NEOS website and look into any of the ETFs and scroll down, you can see right here it says supplemental tax information, 19A-1 notices, and shout out to NEOS because they make it very, very simple to find. You click on this and you can see every single month. Over the last several months, you can click on the most recent one. And just like NEOS says, you can see a more comprehensive breakdown. So this is for QQQI, it says right here, in connection with the monthly dividend payment of 63.74 cents per share payable on May 23rd, 2025 to shareholders of record on May 21st, 2025. It's anticipated that 99% of such dividend will be return of capital. They even break down a chart and show exactly how much is going to be estimated net investment income, prior year undistributed net investment income, estimated return of capital, and total amounts there. Now, before I explain to you guys what return of capital is, and I break down exactly what it means for your personal portfolio potentially, I want to also make this very clear. These are all to be anticipated amounts and or estimated amounts. Now, I'm not saying NEOS has ever done this. I have no recollection of NEOS doing this, but there have been other funds that I personally have purchased in the last decade in my investing career where there can be an estimated amount of return of capital and or an estimated tax treatment. And then later on, maybe towards the end of the year, things can change. Maybe the accounting changes. So again, take it all with a grain of salt. My A to Z dividend investing ebook has helped countless dividend investors get started with their journey. And my custom dividend tracker that I'm constantly using here on the channel has also helped so many investors stay on track and allow them to see their dividend income in real time. Well, today I have another treat for you guys. I'm not only going to offer you my A to Z dividend investing ebook and the custom dividend tracker, but also just for a short limited time, I'm going to be adding in my brand new weekly dividend blueprint ebook to show you how you can get started with weekly dividend ETFs and add this into your investing strategy. This offer is not going to last long, so go ahead and click the first link down below in my description, and you're going to get both ebooks and the custom dividend tracker bundle. But like I said, please act fast because this won't be around for long. Now let's get back into the video. Now, to get into exactly what return of capital or ROC is, again, if you guys are dividend investors, you probably have heard a lot of us other dividend investors talk about return of capital. This is how it is, and this is how it's taxed. So first things first, what is return of capital or ROC? Return of capital or ROC is a payment that an investor receives as a portion of their original investment, and that is not considered income or capital gains from the investment. So remember, if you're going to be earning income and or capital gains, you're going to be taxed on that in a certain way, depending on how much money you make and depend on many other things. But with ROC, it's not considered either of that. Note that the return of capital reduces an investor's adjusted cost basis. Once the stock or ETF adjusted cost basis has been reduced to zero, any subsequent return will be taxable as a capital gain. So to give you guys a real life example, an ETF like SPYI, which does pay at least a large anticipated amount in return of capital, SPYI, just for some round numbers, let's say it costs $50 per share. Now let's say SPYI pays a distribution per month of 50 cents per share. So if we were to consider your original cost basis, let's say you bought one share of SPYI for $50 per share, and then let's say that that next month you got a distribution of 50 cents per share. If that 50-cent payout was return of capital, that would lower your cost basis by how much? 50 cents. So now your new adjusted cost basis would no longer be $50 per share, which is how much you bought your share of SPYI for, but now your new adjusted cost basis would be $49.50 per share. Now assume the next month SPYI does the same exact thing, they pay out another 50-cent distribution. Now your new adjusted cost basis is how much? $49 per share. So over the next several months and years, if SPYI just keeps paying you 50 cents per share per month, your adjusted cost basis is going to go down and down and down. Now what's good about this and what's bad about it? Well, what's good about it is that you're getting paid income every single month and you're not paying a penny of tax on it if we're considering the distributions 100% return of capital. Again guys, I am not an accountant, I'm not licensed for anything like this, so remember, I'm just a random guy on YouTube. Talk to a professional if you have more questions. But basically, over time, as you get paid distributions and as your adjusted cost basis gets lower and lower, you're going to get paid income every single month without having to pay taxes on it. So let's say you hold on to SPYI for several years and now your adjusted cost basis is then zero. So just like it says right here, once your stock or ETF's adjusted cost basis has been reduced to zero, any subsequent return will be taxable as a capital gain. Now the cool thing with SPYI, for example, let's say you bought your share of SPYI, again, just for an example, at $50 per share. And let's say this ETF pays on average around 50 cents per share per month. That means you have 100 months of runway until you're going to have to start paying capital gains tax on those distribution payouts. So some of the key takeaways is return of capital, or ROC, is a payment or return received by an investment that is not considered a taxable event and is not taxed as income. Capital is returned, for example, on retirement accounts and permanent life insurance policies. Regular investment accounts return gains first. Investments are composed of a principal that should generate a return. This amount is the cost basis. Return of capital is the return of the principal only and is not any gain or loss as a result of the investment. So now that you guys sort of see exactly how ROC, or return of capital, works, I'm sure you can kind of understand exactly why so many investors really do want to hold on to different ETFs and or stocks that offer return of capital, because again, you're getting paid a large amount of income and you're sort of kicking the can down the road when it comes to taxes. Now, like I said earlier, if you want to dig deeper into any sort of tax planning or anything of the sorts, talk to a professional. But I just wanted to share with you guys some basics on how ROC is, how it works, and exactly why some dividend investors and income investors are going crazy over some investment vehicles that do pay a large amount of their distributions in the form of ROC. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.